The book starts with the idea that investing is important for building wealth over time. It explains that the stock market is a place where people can buy shares of companies. When you buy shares, you own a small part of the company. The book talks about two main types of investing: active investing and passive investing. Active investing is when people try to pick individual stocks to beat the market. Passive investing is when people buy index funds that follow the market. The book explains why passive investing is better for most people. It says that active investors often fail to beat the market. They spend a lot of time and money trying to pick the best stocks, but they usually do not do better than the market. Index funds are a type of passive investment. They follow a market index, like the S&P 500. The S&P 500 is a list of the 500 biggest companies in the United States. When you buy an index fund, you own a small part of all these companies. The book says that index funds have low costs. This is important because high costs can eat into your returns. Index funds do not need expensive managers to pick stocks, so they charge lower fees. The book talks about the power of compound interest. This is when your money earns returns, and then those returns earn more returns. Over time, this can make your money grow a lot. Investing in index funds and leaving your money to grow can be very powerful. The book explains that the stock market goes up and down. It is normal for the market to have bad years and good years. The book says that you should not panic and sell when the market goes down. It is better to stay invested for the long term. The book also talks about the importance of diversification. This means spreading your money across many different investments. Index funds are naturally diversified because they include many different companies. This helps reduce risk. The book mentions that trying to time the market is very hard. This means trying to buy stocks at the lowest price and sell them at the highest price. Most people who try to do this fail. It is better to stay invested and not try to time the market. The book suggests that people should start investing as early as possible. The sooner you start, the more time your money has to grow. Even small amounts of money can grow a lot over a long time. The book also talks about bonds. Bonds are loans to companies or governments that pay interest. Bonds are usually safer than stocks, but have lower returns. The book says that having some bonds in your portfolio can make it less risky. The book says that it is important to keep investing simple. Complicated strategies often do not work better than simple ones. Index funds are a simple and effective way to invest. The book explains that many financial advisors and fund managers charge high fees. These fees can take a big part of your returns. The book suggests that people should be careful about paying too much in fees. The book also talks about taxes. Different investments have different tax rules. Index funds are often tax efficient because they do not buy and sell stocks frequently. This means you can keep more of your returns after taxes. The book says that investors should focus on what they can control. This includes keeping costs low, staying diversified, and staying invested for the long term. Trying to pick the best stocks or time the market is usually not worth it. The book mentions that sometimes the stock market will have bubbles. This is when prices go up too high because people are too excited. Eventually, the bubble bursts and prices go down. The book says to be careful and not get caught up in bubbles. The book ends by encouraging people to be patient and disciplined. Investing is a long-term game. If you stay focused and stick to a simple plan, you are likely to do well. In summary, the Little Book of Common Sense Investing teaches that low-cost index funds are a smart and simple way to invest. It explains why passive investing, diversification, and keeping costs low are important. The book encourages long-term investing and avoiding complicated strategies. It provides practical advice for building wealth through sensible investing.